Welcome to the Tim Booker channel where wisdom is worth spreading. Wishing you a delightful audiobook experience. In this episode, we delve into The Warren Buffett Way, a book that introduces the investment philosophy of the legendary investor, Warren Buffett. Buffett, a well-known figure in the investment world, became the world's richest person in 2008. He leads Berkshire Hathaway, a company ranked in the top 10 of the Fortune 500 with a per-share value of as high as $300,000, approximately 2 million renminbi, making it the most expensive stock in the world. Buffett's entire wealth is the result of his successful investments, making him a deity-like figure among investors. Everyone hopes to learn the secrets of investing from him. Let's look at two examples. One is the Berkshire Hathaway annual shareholder meeting, where tens of thousands of investors from all over the world fly to the small city of Omaha, USA, just to catch a glimpse of Buffett. Omaha, located in the Midwest of the United States, has a population of only 400,000. The other example is the famous Buffett charity lunch, where some people would spend millions of dollars just to have a meal with him and listen to his wisdom. Surprisingly, this meal consists of a simple steak, with an average cost of less than $100 per person. Why is Buffett such a successful investor? Does he possess some secret? To unravel the mystery behind Buffett's investment prowess, countless books have been published worldwide. Among them, The Warren Buffett Way is widely recognized as the best summary of Buffett's investment philosophy. The book reviews the formation of Buffett's investment style and analyzes classic investment cases from his 60-year career. It condenses Buffett's stock selection methods into 4 major investment principles. Additionally, the book also introduces Buffett's standards for selecting people, emotional management, and thinking methods, which have applications far beyond the field of investment. The legendary fund manager, Peter Lynch, said that this book encompasses the thinking and philosophy of a successful investor, and its methods are valuable for individuals of any financial level. The author of this book, Robert Hagstrom, is a fund manager who excels in researching and writing about Buffett and Munger's ideas. His works, including The Warren Buffett Way, Buffett's Portfolio, and Charlie Munger's Wisdom, are all classic bestsellers in the investment field. The book believes that while ordinary people may not become billionaires using Buffett's methods, they will undoubtedly improve their long-term investment skills and become better investors. I will explain 3 key points for you. 1. The path of an investor. How Warren Buffett formed his investment philosophy. 2. The art of stock selection. What kind of companies does Warren Buffett prefer to invest in? 3. The method of buying and selling. What kind of mindset does Warren Buffett adopt during investment transactions? Let's start with the first question. How did Warren Buffett form his investment philosophy? Warren Buffett was born in Omaha in 1930 and was fascinated by numbers and money from a young age. He started buying stocks at the age of 11. In his youth, he searched through countless books on stocks and even drew stock price charts himself. However, after several years, his skills were not significantly different from those of an ordinary small investor at that time. So, how did Warren Buffett develop his own investment style later on? He was mainly influenced by 3 individuals, Benjamin Graham, Philip Fisher, and Charlie Munger. Let's introduce them one by one. The first person is Benjamin Graham, whom we are not unfamiliar with. He was Warren Buffett's professor at Columbia Business School and the founding father of the securities analysis industry. He is also known as the father of Wall Street. Graham wrote 2 books, Security Analysis and The Intelligent Investor, with the latter often referred to as the Investor's Bible. When Buffett read these 2 books before he was 20, he had an epiphany about the essence of investing. He joined Graham's school and systematically learned the value investing theory. The main principles of value investing, which significantly influenced Buffett's investment views, can be summarized as follows. 1. When buying stocks, you are essentially buying a stake in the underlying company. 2. Seek to purchase stocks at a discounted price. 3. Learn to embrace market fluctuations. In his younger years, like most investors, Buffett viewed stocks merely as pieces of trading paper with prices. However, under Graham's influence, he came to realize that stocks represented tangible ownership in real companies, regardless of whether he bought a small or significant portion of a company's shares. Graham emphasized the importance of focusing on the true value of a company's business rather than being fixated solely on stock price fluctuations. The second point is buying stocks at a discounted price. You may have heard the famous investment adage, rule number 1, never lose money. Rule number 2, never forget rule number 1. This saying originated from Benjamin Graham. So, how can one avoid losses? Graham's method was to buy stocks at prices significantly lower than their intrinsic value. By doing so, investors can ensure that they have a margin of safety, and even if they make a wrong judgment, they are less likely to incur substantial losses. The intrinsic value of a company depends on factors such as its assets, profits, dividends, and future prospects. When the stock price is significantly lower than this intrinsic value, investors can buy with confidence, as the investment carries lower risks. The third point is how to approach stock market fluctuations. Benjamin Graham introduced a prophetic figure known as Mr. Market, who arrives at investors' doorsteps every day to report stock prices. However, Mr. Market's emotions are not stable, sometimes being optimistic and other times pessimistic, leading to fluctuating stock prices. Yet, the true value of the companies represented by these stocks does not fluctuate to the same extent every day. As an investor, the key is to remain rational and either ignore or leverage the opportunities brought by Mr. Market. Building on the three principles he learned from Graham, Warren Buffett's early investment career was quite successful. His private investment fund also experienced rapid growth. However, with the increase in funds, he discovered an issue with Graham's approach, which prioritized price over quality. He often ended up buying struggling companies with promising prospects, but he had to find ways to bankrupt them to liquidate their assets and recover his money. Realizing this problem, Buffett gradually shifted his investment style to focus on the teachings of Philip Fisher, a value investor like Graham, but with a completely different stock selection approach. While Graham emphasized the cheapness of a company, Fisher prioritized its growth potential. He was more willing to pay a fair price for good companies and growth stocks. To illustrate, Graham was like buying something worth $1 for only 50 cents, while Fisher was willing to spend $1 to buy something that would be worth $10 in the future. To identify such valuable future companies, Fisher emphasized two factors: buying good companies and selecting excellent management teams. His approach to analyzing companies also differed from Graham's quantitative analysis of financial statements. Fisher advocated qualitative research and encouraged investors to visit and observe companies' operations and management. Fisher placed significant importance on a company's competitive moat, later referred to by Buffett as an economic moat. Buffett was introduced to Fisher's ideas early on and appreciated them, but it was Charlie Munger who truly helped him break free from his previous ingrained thinking and transform his investment style. Munger, Buffett's partner and mentor, had two major influences on him. Firstly, he urged Buffett to pay a fair price for good quality, moving away from Graham's cheap stock mentality. Secondly, Munger encouraged a multidisciplinary approach, using knowledge from various fields such as science, history, philosophy, psychology, mathematics, etc., to arm his mind for investment decision-making in all aspects of life and work. With Munger's influence, Buffett made his first quality purchase in 1971 when he bought See's Candies for 2.5 times its net assets, a price he wouldn't have considered in the past when he only sought companies with a price-to-net assets ratio of 1. This investment turned out to be one of Buffett's most successful. In 1978, Munger and Buffett merged their investment companies, becoming official partners, and together built one of the world's largest investment empires, Berkshire Hathaway. Every year, they sit together on stage for hours, answering various questions from shareholders at the Berkshire Hathaway Annual Shareholder Meeting, an annual spectacle in the investment world. Munger not only became Buffett's partner but also a great thinker with multidisciplinary wisdom. He established knowledge in various fields, including science, history, philosophy, psychology, mathematics, and more, and applied this knowledge to investment decisions in all aspects of work and life. Now, let's recap the first key point. We have reviewed Warren Buffett's path to becoming the Oracle of Omaha, from learning Graham's idea of buying stocks as buying companies to adopting Fisher's approach of buying good quality and growth stocks and ultimately embracing Munger's multidisciplinary thinking. This process allowed Buffett to create his unique investment system. Continuing with the second question, how does Warren Buffett select stocks? Despite being nicknamed the Oracle of Omaha, Buffett does not engage in stock speculation but focuses on investing in companies. He believes that buying an entire enterprise is essentially the same as purchasing a portion of its stock. Therefore, when making investment decisions, Buffett analyzes the company itself rather than the market, macroeconomics, or individual stocks. The book summarizes Buffett's investment approach into 12 principles, which I'll break down into 4 parts, referring to them as the criteria for selecting number 4 companies. 1. Enterprise criteria, assessing the quality of the business. 2. Management criteria, evaluating the competency of the executives. 3. Financial criteria, analyzing the profitability and returns. 4. Market criteria, considering the stock's price and valuation. One of Buffett's favorite beverages is Coca-Cola, which also happens to be one of his most famous investment cases. Using Coca-Cola as an example, let's take a closer look at the characteristics of number 4 companies. Starting with the first criterion, evaluating the quality of the business, Buffett has 3 requirements for companies he likes to invest in. 1. The business model should be straightforward and easily understandable. 2. The company should have a long history of stable operations. 3. The long-term prospects should be clear and visible. Buffett coined the term economic moat, which represents a sustainable competitive advantage that allows the company to defend against competitors. The wider the moat, the stronger the company's sustainability, making it more appealing to Buffett. The book lists 9 classic investment cases from Buffett, such as Coca-Cola, IBM, Wells Fargo, American Express, and more. These companies are not only well known in the United States but are also globally recognized. They are businesses closely related to people's daily lives, providing consistent products and services for decades, and have substantial financial data available for analysis. Their future growth direction is also evident. For instance, take Coca-Cola. It has been selling syrup-based beverages for the past 100 years, and the probability is high that it will continue to do so for the next 100 years, as people around the world continue to consume these beverages. The company maintains a consistently high profit margin, making it a comprehensible and excellent business. Moving on to the second criterion, evaluating the quality of management, Buffett once said he likes to buy businesses that can be run by fools because the critical factor is not how to steer the boat but what kind of boat it is. However, this does not diminish the importance of management. Even a business that seems simple to run cannot withstand the reckless behavior of poor management. Throughout Buffett's investment career, he refused to buy businesses without strong management, no matter how attractive the underlying business seemed. So, what constitutes good management? Buffett believes the best management should act as if they are owners of the company, working to maximize shareholders' interests. Specifically, Buffett has 3 requirements for good management. 1. Rationality, the ability to allocate resources efficiently. 2. Candor, being truthful about both good and bad news, admitting mistakes and failures. 3. Independent thinking, the capacity to avoid following the crowd and not being influenced by the majority. The first 2 points are relatively easy to understand. Moving on to the third point, independent thinking is precisely a scarce quality among most company executives. The majority of management teams tend to overestimate their abilities and are always busy imitating their industry peers. If others invest in a new project, they immediately follow suit. If others venture into foreign markets, they do the same. If another company achieves a 20% growth rate in the current quarter, they dare not report a growth rate lower than 19%. The herd mentality originates from human nature. Not conforming to the crowd's behavior might feel odd or awkward. However, a good manager should avoid following the crowd. Let's continue using Coca-Cola as an example. Warren Buffett did not buy it early or late but decided to invest in 1988 because he was attracted to the changes in Coca-Cola's leadership. Throughout the 1970s, Coca-Cola faced continuous troubles, lawsuits, and a sharp decline in operations, resulting in decreasing profit margins. The company's stock price significantly lagged behind the S&P 500 index due to poor leadership. Paul Austin, the chairman at that time, made decisions arbitrarily and focused on maintaining revenue growth through blind expansion. He acquired numerous unrelated and unprofitable businesses, including a non-profitable winery and investments in water and shrimp farming, yes, shrimp farming. In 1980, when new management took over, they sold off the unrelated industries developed by the previous leadership and refocused on the core business of selling syrup-based beverages. They also started cost-cutting measures and set clear objectives to improve profitability. So, how can one judge whether the management is doing well? Buffett offers some tips. Firstly, review the company's annual reports for the past few years, paying attention to the management's future strategies and comparing them with the actual results. Additionally, examine the financial data, which is the third essential element in evaluating a good company. From a financial perspective, the focus should be on whether the company is profitable and how it rewards shareholders. Buffett concentrates on two metrics: profit margins and return on equity, ROE. These figures reveal how much profit a company can generate per dollar of sales or invested capital, respectively. These indicators genuinely reflect the company's long-term profitability. Furthermore, analyze whether the company's profits are effectively reinvested to create more value for shareholders. Buffett created a metric called the $1 principle. It states that for every dollar of profit retained within the company, at least $1 of market value should be created. The most critical task for management is to decide how to allocate the company's profits. Any profit not distributed to shareholders should be used to grow the business effectively, otherwise, it demonstrates irresponsibility towards investors. Now, looking back at Coca-Cola's case, we can see that its profit margin was as low as 12.9% in 1980, but by 1988, the year Buffett invested, it had risen to a record 19%. During the same period, Coca-Cola's market value grew at a near 20% rate. In other words, for every dollar retained, the company created $5 of market value. The change in leadership at Coca-Cola in 1980 yielded immediate results, and Buffett decided to buy in because he recognized the good returns, good business, and good management. However, even with these positive attributes, it's essential not to pay too much for a company. This is Buffett's fourth criterion: is the stock price good? To get a discount on your investment, you first need to determine the company's intrinsic value. Calculating a company's worth is similar to evaluating an investment in a shop or a small business. You should consider how much return you want annually and in how many years you want to recoup your investment. For a company, there are more factors to consider. For example, how long will it last, how much capital will it require annually, what will its net earnings be, will there be any changes in the primary business, are there better investment opportunities in the same period, etc. Buffett emphasizes that a rough estimate is better than a precise error. Knowing the company and being able to roughly estimate its long-term return is what matters. According to the book's author, when Buffett invested in Coca-Cola, its market value was around $15 billion, while its true value ranged from $20 billion to $48 billion. Even with the most conservative estimate, Buffett bought Coca-Cola's stock at a 30% discount. In another case, when Buffett invested in the Washington Post, he bought the stock at an absurdly low 2/3 discount. So, how did these investments turn out? In 10 years, Coca-Cola's stock price increased tenfold, while the Washington Post's price grew 36 times in 20 years. Including dividends, the average annual return exceeded 20%. This 20% became a classic in Buffett's investment cases. To sum up, the three key factors for a 3-in-1 company: good business, good management, and good returns, are a dream come true for investors. However, one should not pay too much, seeking a discount on the investment, and be able to roughly estimate the long-term returns. These principles, inspired by Warren Buffett's investment approach, have become classics in the investment world. In summary, we just discussed the 4 key criteria Warren Buffett uses to select companies: good business, good management, good returns, and good prices. All 4 elements are indispensable. Now let's move on to the third question: what mindset does Buffett adopt in his investment approach? In truth, Buffett's stock-picking approach is not mysterious. He seeks out good companies with excellent business models, competent management, and strong financials, all at a favorable price. Once he identifies such opportunities, he buys and holds them. This method is not only understandable to Wall Street professionals but also manageable for ordinary people. However, the reality is that in the United States, buying shares of Coca-Cola is probably one of the least challenging investment decisions. Coca-Cola is essentially a symbol of America, with nearly every American having tasted its product. Moreover, the company's stock has been listed since 1919. At the end of the 1990s, the book's author attended various investment seminars and asked the audience, who held Coca-Cola stock in the past 10 years. Almost everyone raised their hand. Then he asked, who achieved the same returns as Buffett? All hands went down. Buying the same Coca-Cola stock, why didn't others earn as much money as Buffett did? In investing, knowledge reserves only answer what to buy, while psychological preparation determines how to act. Here, let's discuss the three most important thinking methods that Buffett emphasizes in investment education: the circle of competence, probabilistic thinking, and inverted thinking. The first is the circle of competence, which refers to an individual's range of abilities. Buffett constantly emphasizes investing within one's circle of competence. In other words, to increase your success rate, focus on doing things that are within your capabilities and avoid attempting things you can't do. This is crucial in the investment field. Most people tend to chase new concepts, trends, or hot stocks during different market phases. However, Buffett almost never pays attention to popular stocks. While others wonder what will change in the future, Buffett focuses on what won't change. You may have heard that Buffett rarely buys tech companies, which prompts some to question if he's outdated and can't keep up with the times. They argue that the tech industry changes too rapidly, and the competitive advantages of giants may crumble instantly. But for Buffett, those are not strong enough moats. Although individual tech companies may yield astonishing returns, the overall difficulty in choosing and predicting the success of such companies is much higher. In contrast, Buffett prefers to invest in companies that sell timeless products like beverages or chocolates. Of course, in recent years, Buffett has invested in a few companies with tech attributes, such as IBM and Apple. However, when he invested in them, what he valued more was their enduring competitive advantages and dominant positions. IBM, as a provider of IT system services, was the only investment that didn't meet his expectations, and Buffett sold it in 2018. He has candidly admitted his mistake on multiple occasions, which goes to show that even the Oracle of Omaha can fail when straying outside his circle of competence. The second point is probabilistic thinking, which means seizing opportunities and betting heavily on them. Essentially, investing is a probabilistic puzzle, and the stock market is a vast warehouse filled with various possibilities. Different forces within the warehouse collectively shape stock price fluctuations. Investors must assess the probabilities of various events occurring to make investment decisions. Probability corresponds to odds, which gambling companies offer based on the likelihood of events happening. Generally, odds reflect real-world probabilities fairly accurately, but occasionally, there might be irrational odds. For example, in horse racing, a horse with a half chance of winning might have odds of 1/10, which means you could earn 10 times the bet if it wins. The stock market operates similarly, and investors need this probabilistic mindset to seek mispriced opportunities. Although one should not bet easily, seizing exceptional opportunities requires heavy bets. As these exceptional opportunities are scarce and not easily recognized, Buffett's metaphor is apt: when a large pot of money is waiting to be collected, don't use a teaspoon, use a big basin. You may have heard the saying, don't put all your eggs in one basket, which suggests diversifying investments to reduce risk. On Wall Street, the popular investment strategy is to frequently trade a large number of different stocks, holding hundreds or even thousands of stocks with each occupying only a small percentage of the portfolio. Buffett's view is quite the opposite. He advocates putting all the eggs in one basket but watching that basket carefully. The traditional diversification strategy has a problem: you might end up buying many things you don't understand, increasing the chances of making mistakes. On the other hand, Buffett's concentrated approach is distinctive. He prefers holding shares of a few high-quality companies rather than numerous average companies. For instance, in 1988 and 1989, Buffett invested a total of $1 billion in Coca-Cola, which accounted for 1/3 of his investment portfolio. By 2018, Buffett's controlled funds amounted to nearly $200 billion, with 2/3 concentrated in just 5 stocks. Such a level of concentration in such a vast investment empire is unimaginable. The success of Buffett's strategy has been proven, as the majority of his wealth was generated from just a few investments. The third point is inverted thinking. Buffett's most famous quote might be fearful when others are greedy, and be greedy when others are fearful. Most people have a herd mentality, especially in the stock market, chasing rising stocks and selling when they drop, which leads to widespread losses. Buffett excels at contrarian investing, but being different alone is insufficient. You must understand why others are wrong and what you should do instead. Moreover, you must have strong inner resolve to hold on until victory arrives. For instance, when stock prices drop, most investors cannot tolerate the pain of declining values and sell their stocks at a loss, a practice known as cutting losses or stop loss. Even many seasoned traders on Wall Street adopt stop-loss strategies, where they sell if losses reach a certain percentage to prevent further decline. However, Buffett is different from these people. He is not afraid of falling stock prices. On the contrary, falling prices present him with buying opportunities. The term stop-loss does not exist in Buffett's vocabulary. He does not need stock prices to prove whether he is right or wrong. Time is his proof of correctness. Most people strive to make the most money in the shortest time, which aligns with human nature. However, Buffett embraces long-termism, resisting greed and fear, and becomes the winner of the game. According to statistics, the longer the time horizon, the more stock returns align with a company's operational and profit performance. Therefore, uniquely long-term investing is the core of Buffett's successful investment approach. Here, let me elaborate on some thoughts of my own. The three concepts of the circle of competence, probabilistic thinking, and inverted thinking are not only highly important in the investment field but also applicable in other areas. For example, in entrepreneurship, you should develop projects in fields where you have interests and expertise. This is the circle of competence. When you encounter good market opportunities, you should be fully prepared for every detail. This is probabilistic thinking. In the process of entrepreneurship, you will face setbacks and frustrations. When others doubt you, you need the strength and patience to make decisions with a long-term perspective. This requires inverted thinking. Alright, that wraps up the book. Let's summarize the content we've covered in this episode. We've learned about Buffett's success through three main sections. First, we explored Buffett's path to becoming the stock market guru. His investment philosophy was greatly influenced by three individuals, Graham, Fisher, and Munger. From Graham, he learned the idea of buying stocks as buying companies. From Fisher, he understood the importance of investing in high-quality companies, and from Munger, he started to pay a premium for quality. Next, we delved into Buffett's stock-picking approach, using the case of Coca-Cola as an example to understand his four criteria for selecting companies: good business, good management, good returns, and good prices. Finally, we discussed Buffett's buying and selling approach, focusing on his three thinking methods: the circle of competence, probabilistic thinking, and inverted thinking. To succeed in investing, one must be well prepared both in knowledge and psychology. That concludes the essence of this book. Congratulations, you have finished another book. Thank you for your support and attention. Please subscribe to the Tim Booker channel, like, and share with family and friends. Wisdom is worth spreading, and let's create a brighter future together. Thank you, and goodbye.